If you're investing in real estate in the Northeast and you believe the property will both cash flow comfortably and appreciate significantly at the same time, that assumption is where most investors lose. The Northeast does not behave like the growth markets you hear about online. Purchase prices are higher relative to rent, property taxes are structurally higher, insurance is less predictable, and much of the housing stock is older. That combination compresses margin. When margin compresses, mistakes magnify. On paper, a deal may show positive cash flow, but once you model realistic maintenance, capital expenditures, vacancy, and tax adjustments, that margin often becomes thin. Thin margins are not the same as durable cash flow, and durability determines survival. In many Northeast markets, price to rent ratios are elevated. Income relative to acquisition cost is modest. Add leverage, and the cushion narrows further. Now layer in winter exposure, snow removal, heating system stress, roof wear from freeze-thaw cycles, add aging infrastructure in 60 to 80-year-old properties. The spreadsheet projection and operational reality begin to separate. Most beginner investors underestimate capital expenditures. A boiler replacement is not a minor repair. A roof is not routine maintenance. Electrical modernization is not cosmetic. If appreciation is required to justify those costs, the strategy is fragile. Appreciation is unrealized equity. It is not income. It only materializes when you refinance or sell, both of which depend on timing and credit conditions outside your control. In compressed yield markets, appreciation cannot rescue weak cash flow. So the real question is not which strategy sounds better. It is which strategy matches your financial structure. There are two investor profiles that can succeed here. The capitalized long-term equity investor has strong outside income, substantial liquidity, and no dependence on rental income. They can withstand negative carry and operate on a long horizon. The disciplined cash flow investor underwrites conservatively, assumes higher repair costs, maintains meaningful reserves, requires strong debt coverage, and stress tests vacancy. What fails is the hybrid assumption. Limited liquidity combined with thin margins and dependence on appreciation introduces structural risk. Structural risk compounds faster in high-cost markets. Here's a decision filter. Do you require monthly income from this property? Can you sustain 12 months of underperformance without financial strain? Are you capitalized for major system replacements? Is your investment horizon truly 10 years or longer? Does the property meet a conservative debt coverage threshold after realistic expense modeling? If those answers are uncertain, the issue is not the Northeast, it is alignment. Real estate investing in the Northeast can be powerful, but it rewards discipline and punishes optimism. The margins are tighter, the costs are higher, the assumptions must be cleaner. If you invest for appreciation, capitalize for volatility. If you invest for cash flow, underwrite for durability. But do not confuse projection with strategy, because in this region, most investors don't fail because real estate doesn't work. They fail because the math was thinner than they believed. Thanks for watching. I'll see you in the next video.